welcome to a new episode of the Insilico Terminal podcast. Today we are having another project on the podcast with us, so not a trader or anything, but we're talking about a project. And just like a quick disclaimer, like I did last time, this is not like an endorsement or an announcement of integration or whatever. I just like to switch it up sometimes and talk about some different things as well. And I guess I can give it over to our guests today to introduce themselves and what they are working on.
Nice. Hey, everybody. So my name's Lucas. I'm one of the founders of WCM, which is a kind of a unique new on-chain application. We call it a Prime Dex. So it's spot lending perps, fully on-chain, and combining these markets with an intelligent risk engine unlocks arbitrage opportunities and basically, more capital efficiency. It's deployed on MegaETH, it's fully on chain, enabled by MegaETH, throughput, speed, and transaction costs, which, would not be possible on another blockchain to run this kind of application. So that's like the kind of basics of the application.
Yeah. And me, just a dog at WCM, which has now rebranded to World Markets per a recent announcement. And I'm just trying to help out the team with my sort of expertise in the space and whatnot. Just trying to like help them like sort of like find a narrative, right? And try to make sure like what we're building is sort of like actually has a use case, right? So yeah, that's pretty much and I know like people already know about like, oh my God, Hersch is a dumbass, right? He's a retard. Why is he here? Sometimes I'm not that stupid. Yeah, sometimes I'm not that stupid. But yeah, that's pretty much it.
So you renamed the project to World?
Sort of, yeah.
Or?
Yeah, it's sort of like a very sort of recent change. Kevin and I and Lucas, Kevin, who's our other co-founder, we didn't align on the name per se. We were like WCM, right? We're not a big fan of like sort of like abbreviated forms, right? For World Capital Markets, and we're like, let's just drop capital, right? Let's make it World Markets. Sort of like it's easier
cleaner
to roll right off the tongue. And
so we'll call it World for short.
Yeah, it was World, but like then again, World, we tried looking for the Twitter at, and is all these like taken. So we're like, oh, can't do that.
I see.
Should we go into like backgrounds and then kind of talk about the business?
Yeah, that sounds good to me.
Nice. Okay. Yeah. So I started my first crypto company in 2017. I was a co-founder and CTO of that business. We sold the business to Amber Group in 2021, and that business was known for or had expertise in like securities regulations. So we were regulated out of Western Europe, so under MegaETH 2, to operate a securities exchange as an MTF license. And at least to our knowledge, wrote the largest Ethereum code base up until 2021 when we sold to the Amber Group. Those for derivatives, and had some very fairly complex math in the matching engine to kind of match across markets. And then essentially from that business, we had a really counterintuitive insight, which was that there's this relationship between state and risk calculations. So you need, intuitively, when you calculate risk, each variable is dependent on all other variables. So it's kind of a combinatorial problem depending on, for most risk calculations. That requires the state to be in one place. And if you have a hybrid architecture, which is what we built, then literally due to like the speed of light, state doesn't synchronize fast enough to calculate risk perfectly. And so you can still, build a business and build an exchange, but to have like perfect risk calculations at the limit, you need to enforce atomicity. And you could either then build a fully centralized, you could build NASDAQ, right? Binance, not Hyperliquid, fully centralized business, or you could build everything fully on chain. And so that was very counterintuitive because as an engineer, you would never really expect to put like the matching engine on chain. And so that was in 2022, that we kind of had that concept in mind. And then basically had the thesis that blockchains would get very fast and very cheap. Really, in particular, like the EVM would get very fast and very cheap. We have very strong preferences for the EVM over the SVM due to like just kind of how it's built. We think it's like a much more intelligent design. Solidity, not so much, but the EVM is pretty good in comparison. And so we're able to kind of start, doing research and prototyping and thinking about, how to build it very early, because we knew that the execution environment would persist, or at least that was sort of the thesis. And then when MegaETH came out, we were like, okay, now's the time to really, we actually looked at Monad. We spent quite a lot of time understanding sort of Monad ecosystem and the tech. We were there first, believe it or not. And then we learned about MegaETH. We were like, this is just better in like literally every dimension. Except for, I guess, capital raising. Monad raised a heck of a lot of money. But decided ultimately, the MegaETH was a really good fit. And and started working on the properly like working on the business. That's the brief sort of the brief story and history. And the other thing that's, I would say, kind of important is, or maybe this is a bit of like some additional context. So we also started a hedge fund which trades in CeFi and DeFi. I would say we're maybe not the biggest, but within the fund world, pretty close to like the biggest power users on chain. And I was really, a lot of people ask like, why we're working on this instead of like, why not just work on the hedge fund, and like, why do this at all? And I was like super against building another exchange because I know how hard it is, and like the likelihood of success. And so our internal threshold to like want to work on this was, first, there are lots of problems on chain. Like if you're trading in crypto, you're basically getting fucked. Either you're getting fucked on the centralized systems, and we can talk about like, how that all works, or you're avoiding centralized crypto and you're in DeFi, but like, Morpho, you give it $1, it gives you 75 cents. That is not a especially useful product, right, for finance. And so there's just a kind of perfect lack of basic functionality and like, kind of connectedness between markets, and it's all siloed, et cetera, et cetera. So the problems are really obvious. But, let's have somebody else work on those hard problems, and, we'll just trade and make money. So even that like wasn't, the fact that we kind of had a solution to these problems was not sufficient to launch the business. Where it was like, okay, we need to run this business was, I think we know like 90 to 95% of the market. So I know almost every single trading team that trades on chain. Partially because of our history, and partially because the nature of the hedge fund is we don't build internal strategies. We can, but that's not our focus. We actually speak to like every trading team on Earth for crypto.
So you're not just like aware of all of the teams, but you're actually in contact with them, or?
Yeah, like we I do diligence their strategies, and we decide whether to give them money. We're a multi-manager hedge fund, similar to like a fund of fund. So literally, the business is built around sourcing every trading team in the world that touches crypto, understanding their trading in very granular detail, and then investing in the best teams. And when we invest in the best teams, they trade in our account, so we see every single trade. Right. So that's on the hedge fund side. Then there's obviously like prop trading, which is a lot of like who knows who, and we've been doing this since like 2017. So, we know like most of the teams. And protocols want to speak to us, and I know most of the protocol founders. One, having been around, but two, because if you're a protocol, you want clients, right? It's like, who better to talk to than a fund of fund, right? If you want institutional clients. And what became obvious was that not only were there these major issues, like that was self-evident, but nobody was even working on a real solution. That was the threshold for us to want to like work on this business. Was that like, if we don't solve it, actually, like, it's going to be 2 to 3 years at least before somebody has a credible solution to the problem.
The problem being like capital efficiency here, basically, right?
Yeah, the problem being, if you, let's say you like crypto, for whatever reason, you've decided that like this is interesting to you. If you trade on any of the centralized exchanges, like they, including Hyperliquid, by the way, which was way better than, like way more transparent than say like Binance, they get to unilaterally decide like when to unwind your positions and at what price. That is insane, right? Like there is not a respectable financial market on earth where that is the case. Not to mention like, getting locked out of your accounts and getting kicked off the exchange. And, as protocols, you're either paying like what amounts to a bribe or, getting delisted, right? It's like, it's just not good. So that's like the centralized world. Then there's the decentralized world, which is like, okay, what do you trade on, right? Uniswap, like that's not a market, right? Like over collateralized lending, it's not a product either. There is no real option. Like Vitalik wrote an article, which I really loved, called like Safe DeFi, making the case that like DeFi is Google mode, like, Google has search, right? So what does Ethereum have that has Safe DeFi? It's like, that's great, but it would be even better if it was like safe and useful DeFi, right? If a market is just subsidies, it's not a market. And so you need like trading infrastructure. You need like an exchange that people can actually use, like real traders, people who are looking at like, taking the market data and then based on signals, generating a price and trading at that price, like, having a view or, like that's like actual trading. Selling AVAX that you get from like sticking your money in an Euler pool is not trading, unfortunately. Right? That's all subsidies. Points farming, subsidies. You can only kind of do that for so long.
So how does your product come into that?
Yeah, so basically our knowledge from traditional markets, we have quite a lot of like traditional market expertise, Harvard, Citadel, Goldman. And DeFi, been doing this a long time, very technical, both on the builder side and on the trading side. We have views on like what a market really looks like on chain. So I could actually, let me just sort of open my, can I share a screen?
I think you can, yeah. Guess you should be able to.
All right, great. Okay, and I'll kind of talk through this for people on audio. So this is what it currently looks like, and it'll look, a lot cooler leading up to launch, which is we expect like February 1st. So there's perps, spot, and lending. That's the first thing you'll notice. All on one venue, and everything's order book based, including lending. And the reason is because, like one, an order for a market, and you need an order book for a market. Like an order book is the literal manifestation of, aggregating preferences and then like sorting preferences by price. It's the definition of a market. You can't have this like AMM sort of situation. Okay, so that's on kind of like the, 3 markets. You also need loans to be order book based, or at least you can't have pools. This was actually proven in the 70s. Somebody won a Nobel Prize for demonstrating why you can't have like pool-based lending, or really like pools in general, due to adverse selection, because debt spirals, et cetera. So, you have like, you can build a really simple UX on top of it where you're, obvious style or whatever. But it's important for risk that, loans are correctly structured. It's 10-day terms with a fixed interest over those 10 days. That means that, you can't manipulate the pool. You don't get, locked in things, et cetera.
So you basically have like limit
anyway,
orders inside of the order book at different exchange rates, which people can
Diff-
then
yeah,
fill.
different interest rates. So
Interest
I'm
rates,
willing
yeah.
to, borrow at 6%, and you're willing to, lend at the same rate, right? And then people can express preferences. Let's say that, I'm willing to lend, but only if you can pay 8%, right? Like I can stick that order in the book, and I can continue trading, doing other things until that gets filled. Again, like markets are literally expressions of preference. That's what makes a market, and why a market is, why you need markets for society instead of like like a central government kind of making decisions for everybody. It's like literally an aggregation of preferences. Okay, so what's really cool is that there's universal margin. So when all of your positions are considered holistically, the risk engine finds opportunities to make more money, or to reduce your risk. And it does that like automatically is maybe not the exactly correct word, but it does that natively, so to say. You could say like it does that automatically. Really, it's like atomic, but yeah, you get the point. And so
what exactly does that mean? Like, what does it mean that it does that, like, not automatically but natively?
Well, if I were to hear the word automatically, I would think that it's like I would think of like a sequence of calculations. You know what I mean? Like one calculation triggers the next. In this case, it's not a sequence of calculations, but it's literally like the state itself. Going back to kind of what, the origin story, which was we recognize this counterintuitive relationship between state synchronization and risk calculations. Doing everything on chain, we're able to know like the full state of your portfolio, the liquidity in the order book, and the trade all at like simultaneously. And the calculations around like what trades you can do, how that affects your portfolio, the risk you can take, etc. That all happens atomically as well. And so it's this like instantaneous, it's these like almost discrete, I guess they are technically discrete because of block times, like these discrete instantaneous moments in which everything is known and correctly calculated. And because it's instantaneous, you're able to safely increase leverage, safely kind of uh, expand relative to, less efficient systems. The efficiency in that efficiency makes everybody more money.
Does it like
maybe this is a bit of a
require
very theoretical description, but
does it require manual user input? Like, are there some propositions, for example, or is it something that the system just does like by itself?
so the system does it instantaneously at every moment. So it's just a fact of state, if you will. The UI makes gives the user, helps the user take full advantage of that state. And so let me find a good one here. So we have this trade that we like to use to sort of showcase all these things I'm saying that feel like very maybe ephemeral. This trade illustrates these things more clearly. We call it the bullish levered basis trade. So everybody knows the basis trade, or most people do. You hold spot of some asset, let's say ETH, and you sell futures of the same asset. And if you do it in the same size, your net market exposure is 0, right? Because the long position cancels out the short position. And so you earn the funding rate. Now, if you do this on Hyperliquid, then you'll make about like 4-ish%, depending on the asset and the market, but that's kind of like average. And the math here simply is you start with $10. You're going to take 4 of those $10 and buy ETH spot. You're going to take 4 of those $10 and short ETH futures. And then you need 2 of those $10 to hold as collateral for your ETH futures. And so your P&L is then, the $4 in the funding position, or the $4 notional, times the rate you're getting on that position, which is typically like 11%. Call it 10%. So, you can do the math. So, and that's like, you can do the trade more efficiently. So you could, instead of doing like 4, 4, and 2, you could do 5 and 5. But that's the, it's in that range. The world markets version of that trade does 50% returns, can actually do higher than that. And the reason is because of this sort of the things that I've been talking about, which are maybe feel theoretical. That's the like direct impact. So if you look at this, this menu that I'm showing on my screen, there are 3 trades which get bundled into this, single trade. So the first is that you're going to borrow under collateralized from the lending market. You can borrow under collateralized again because you have these 3 markets on one venue, and so that capital doesn't leave the exchange, and so on and so forth, right? Like the risk engine understands under collateralized loans and can price them, perfectly efficiently with relative to like everything else. So, okay, so you're going to borrow under collateralized. So in our example, where we were describing kind of the contrast with Hyperliquid, we start with $10. The first thing you're going to do is borrow $90. So now you have 100. All right. Then you're going to take all $100 and you're going to buy spot. So you're going to buy ETH spot. And then you can simultaneously short $100 worth of ETH futures. And world markets recognizes that the long and the short position net to 0 in terms of their market exposure. So it literally understands net market exposures like natively. And because it knows that you can't get liquidated based on the price path of ETH or whatever the underlying asset is, it allows you to apply more leverage to that position. Portfolio leverage, which is why at the beginning, like when you think about this whole trade, right, and think of it as like one unit, we started the trade by borrowing. We can borrow a lot under collateralized because the full trade, the borrow plus the spot plus the futures, is considered together, right, as like one unit. And that then unlocks this extra leverage safely, again, because it knows the risk of your full portfolio after including the transaction, right? Like the state change. It thinks of risk as like the end state, and then determines like, where you can unlock leverage or have like lower liquidation prices if you're long, so on and so forth. Does that make sense?
makes sense to me. I'm just like very curious about the associated risks with like all of this, because there are like probably reasons why this hasn't really been done before so far. Maybe you could go a bit into that and then like talk about what the risks are and how you're like mitigating them.
Yeah, so I think what's interesting is that there's no product like this that's been built due largely to the fact that blockchains have not been fast or cheap enough historically to build it.
Mm-hmm.
One of the other reasons we like, the EVM, maybe self-evident, but just to mention, Ethereum, which is, slow, expensive Ethereum, has many multiples more TVL than all other blockchains combined, in which you count like, Bitcoin's value. And that's due to like platform economics and sort of the network effects in platform economics. And liquidity is important to us. We want to be on a general purpose chain. We don't want to build, like, I think the app chain thesis is like intellectually weak. Sorry if I am offending anybody here, but I don't think it's like especially well thought through. For DEXs specifically, maybe for other things, I'm sure it makes sense. But and so that's like a core, part of the product. Now, if you look at, say, like centralized exchanges, why haven't they done this?
Mm-hmm.
So actually, it has been done. And what's funny is that it's done very selectively. So where it's done today partially is Binance. You can actually do this on Binance. What's funny is that, consistent with like general centralized exchange world, you can only do it in markets that they own, meaning that they issued the asset or they have invested in the asset, and they want to sort of support trading for that asset. Then they do enable this. So, they have like their own Solana wrapper, BNSol, right? They have their own dollar wrapper. They own, a big chunk of Athena. For those markets, they actually do allow it, and it works great. So that's one. And then, like, yeah, I mean, that's really kind of that. So that's like on the centralized exchange side. And then like different exchanges have different go-to-markets, right? So, Hyperliquid's go-to-market was, even though it's centralized, it's obviously entirely unregulated and permissionless, and anybody can make an account. And like at the time, the other centralized exchanges were getting regulated and having to like kick people off, etc. But fundamentally, Binance is very fast to list things. And, if you ask like your typical, especially like VC today, how to build a perp DEX, everybody and their mother tells you the name of the game is to be fast to list things and be first to list. And really it's because they're just sort of copying the leader. It worked over there, so why, just kind of do what worked. The obvious problem is that because it's a competitive market, if you just copy the leader, like you're for sure not, it's, that actually doesn't work because you have to, why would anybody use your thing if it's the same as the other thing but worse? So the thing is, if your whole premise is to be first to list, you actually cannot do what we're doing because you bring assets onto the exchange which have so much like risk associated with them. Whether it's like they can go to zero because they actually like aren't really worth anything credibly, or usually like, that's like the main issue, or, liquidity is controlled by like 8 people, so on and so forth, then it introduces too much risk to the exchange as a whole. And so we actually don't like, we are not trying to be first to list everything. We do want to be first to list things that are of high quality. So
what is like your criteria for listing something then? Or what are like the things? Do you just have like the top 20 or 50 coins or something for the beginning, or what is that going to be like?
Yeah, so at the beginning, it will be a narrow set of listings, really with the purpose of just, bootstrapping liquidity. I don't think it's good to list like everything under the sun to bootstrap liquidity. But once we get sort of at the margin, a good, like the example I like to use is, we're in the MegaETH ecosystem. There are a lot of high quality projects in MegaETH that are also very new, right? That's fine. But these are like, real founders building real businesses, where we can have there's like some coherent view on this thing is not going to go to zero, right? Like we can stomach volatility because there are risk parameters that, like essentially the risk, the way risk is calculated is your portfolio determines your risk budget. And when you take risk, you consume margin, you consume available margin. And if you take more risk, you consume more margin, pretty straightforward. So if we list an asset that has high volatility, that asset is just going to consume more margin kind of on a, per dollar basis than something that has low volatility. So that's relatively straightforward. There are also like liquidity parameters, etc. What doesn't work is if the thing is like, could go to zero or is controlled by like 5 guys, right? It's like, it's not a high quality asset fundamentally. That's really like kind of the delineation between what we can list and what we can't. Hyperliquid doesn't have that same delineation, right? And obviously, they've been unbelievably successful as a business. And like I'm also, even though like we're building a, say competing product, I complain about Hyperliquid, like they introduce a level of transparency to the industry that no centralized exchange is ever going to do. And, like, like to the benefit of everybody, right? So pro Hyperliquid, especially compared to like the other centralized exchanges. But their go to market, like they don't care what the asset is as long as like their premise is that people want to trade the asset, whatever it is. And that's going to bring users to the exchange because you can't get it somewhere else. And then some of those users stay. And that works, right? Clearly, it works really well with them. Just a different value proposition, right?
I'm curious, like, what would happen with your exchange on a day like October 10th, for example, when there are like huge price dislocations, even in like major assets that I feel like that could pose like a major risk in that case, no?
Yeah, that's a great question. So there are kind of a couple of pieces to that. One is that the exchange has circuit breakers. Our exchange does, and I'll kind of get to that. But the first thing is, well, what caused the issue? It was referencing local order book data to set a mark price. And that, we don't do for obvious reasons. And I mean, the fact that finance did it sort of this late into the game is a little bit surprising. But okay, that's kind of like the basics. Then the next thing is risk limits on the exchange. So these are public, they're fully on chain. The kind of interesting thing about risk limits being public and on chain, as opposed to set by, some internal committee at Binance or Hyperliquid for that matter, is that in theory at market equilibrium, those limits should be like optimal, right? Because if those limits are too conservative, it's optimal because there's perfect information symmetry. Like the people who suggest the limits and the people who use them, the traders, have perfect information symmetry and talk to each other. So if the limits are too high or too low, like it should actually kind of recalibrate very fluidly. Whereas like on Binance, like first of all, nobody knows who sets the limits. Nobody's ever met that guy. And second of all, if you don't like them, good luck. So the second thing is then, the risk limits. It's like, are the risk limits in place to protect against these scenarios? Then it's, okay, let's say that like the risk limits were just like the move is so extreme that there's like nothing you can do. Then there are circuit breakers, which is to handle these like October 10th scenarios, just the most extreme, price goes to 0 in 2 seconds kind of situation. In that case, it pauses liquidations, it pauses trading. It gives traders time to increase their collateral, to manage their positions elsewhere. Trading then resumes shortly thereafter. And you can cancel your orders, right? The market then like picks up from there.
Would you still be able to like withdraw in that situation? Because like circuit breakers aren't really a thing that's like been done in crypto before.
Yeah, that's a good question. So the circuit breakers, part of this is still in development. You could withdraw, but you would not be able to withdraw like beyond your collateral requirements, right? So if you were like, get me out of here because I know I'm going to lose my shirt, you can't withdraw your shirt. Like the exchange won't let you withdraw capital that is at risk, kind of consumed by your positions, etc. If you were in spot and only in spot, right? That's not a contract, and it's also not subject to getting liquidated. So you could withdraw that. But say you couldn't withdraw a spot that was used as collateral for like a perp or something. But that's kind of like the sort of the third line of defense. Then there's the question of, well, what happens if like none of it works, right? Which is to say like maybe FTX, where that's not like a glitch. That was the market, repricing this event.
Yeah.
What's interesting is that world markets does not have any ADLs. We actually think ADLs are like not necessary and kind of a historical artifact. ADLs, the reason ADLs were actually created is because crypto exchanges were built like casinos, not like exchanges. And if you're the casino, like if you're the house, then it's really convenient to be able to, like at your own, kind of when and how you feel like it, unwind like the people betting against the house, right? Unwind the players unwind the positions.
Yeah.
That's why ADLs exist. But if you're building an exchange, you actually don't need them to manage risk. So the way it works on WCM is, or on world markets, is every contract is bilateral. So if you're long perps, there's somebody on the other side who's short perps. And if you're a counterparty in this scenario, right, we're saying that the market has moved so quickly that, the risk limits, circuit breakers, like nothing has worked, right? Your counterparty can't pay you as much as you're owed. That loss is socialized bilaterally. Sorry, it's not socialized, is actually the point. It's socialized amongst their counterparties, but it's not socialized amongst like the exchange as a whole, right? Nor is it eaten by like the exchange's internal trading desk. We don't have an internal trading desk because that's a casino, not an exchange. And even if you like hyperliquid returns, and I like them as much as the next guy, right, wider as well, those trades are against the users. It's a zero-sum game, right? So every dollar P&L in that vault is $1 less kind of in the hands of the traders. So like, again, losses are counterparty to counterparty. They're not sort of exchange-wide or socialized in this way. There is not this kind of like discretionary like unwinding of people, so on and so forth. Anyway, so that's how risk is. And what that means, what's kind of interesting then is, if you're sophisticated, and let's say that you care a lot about this particular risk, right? ADL risk or, risk on the exchange, et cetera, you can actually just take a view. So let's say that like, I think the exchange risk settings are wrong. ETH is priced, not conservatively enough, for example. And my counterparty is leveraged to the max on ETH, I can actually swap my counterparty.
How would that work? What exactly would that mean?
What it means fundamentally is that you just close and reopen your position, and you reopen it from a new counterparty in your order book.
I see. So each trade basically has like their own designated counterparty instead of like total open interest or something like that.
That's right. Yeah. Because risk, again, this was proven in the 70s, right? We're 50 years behind on catching up to what we already know. Risk should not be pooled. That just like doesn't work. It doesn't really work ever. You can like the only sort of situation in which it kind of works, like what doesn't work is when risk is pooled and the outcome is shared. So that's a important nuance. You can pool risk, but then you need a price. And importantly, like if you're pooling risk, that's like a actual like trading asset management function with like hyper specialized knowledge about like what the risks are and where the pricing is accurate, etc. Then you're just trading. But let's say that like like an insurance market, right? Which is sort of the typical example used to illustrate the point. If you have, I'll just kind of give you the conclusion of the research in the 70s. Let's say you have a group of sick people and a group of healthy people, right? The healthiest person in the sick group is the most incentivized to leave because they're all paying the same insurance premium.
Yeah.
Right? They're all paying the same percentage. And so the healthiest person is subsidizing everybody else, right? So the healthiest person wants to leave, right? They're the most incentivized to leave, and so they leave. The person who is most incentivized to stay in the group is the sickest person in the group, right? And as soon as the healthy person, the healthiest person in the sick group goes to the healthy group, right? Like you see the problem. And so if you actually just like look at, if it's like a free market and everybody gets to choose, like the whole market collapses due to adverse selection. So like the healthy, like these two groups dissipate into like each individual person, right? The healthiest person in the healthy group leaves, right? So that guy's on his own now. The healthiest person in the sick group joins the healthy group. Now the sick group you get the point, right? So you just extend the duration. Anyway, that's the proof. It's not complicated. So
I'm curious, like I'm not sure if I understand how exactly that would work on the exchange. Like if you have a certain size, you would need to find someone else that is like willing to have a position against you with that exact size.
No, like so pick a position. Let's say you have a do you have a preference?
I don't know. Let's just say ETH one ETH long.
Okay, so let's say if you're long spot, there's no counterparty, right? But let's say you're long ETH perps, right? Okay, so you're 1 ETH long. When you place, so let's look at the original trade. So kind of like T0, you go 1 ETH long perps. It's very unlikely at T0 that you would like match with another guy who's exactly short 1 ETH perps, right? So you're probably there's already like you have multiple counterparties. Let's say you had 2. So you have you're long 1 ETH, and on the other side of this you got somebody who's short 0.2 and somebody who's short 0.8, right? And let's say the 0.8 guy, you're like, this guy's like super leveraged, like I don't like it. You can actually unwind that position. So you would go in and you would select the exchange keeps from the UI perspective, you see like long 1 ETH, right? I can actually even like show you. Let me open a position.
Well, I'm not sure if I like see your screen anymore. Maybe you need to like
Oh, let me
reshare.
share my screen. Okay. All right, so far so good.
Yep.
All right, so in this case, I'm long like 3.05 ETH, right?
Mm-hmm.
So what's interesting, if I go into details, then, all right, well, in this case, I do only have one counterparty. So let me go long a lot more. Get like a partial fill going on. Yeah. Okay. Did this stop sharing? Okay. All right. So, all right, now I'm long 21 ETH.
Mm-hmm.
And I'm at risk of getting liquidated. Well, all right, I still only have one counterparty. I have a pretty big counterparty on the other side of this. All right, well, point is that like, normally if I was like this long, right? I guess in this case, I only have one counterparty. But say I had two, you would see more rows in this table, right? Which would be, the typical case.
Yeah.
So I can actually go, and so maybe it's like, I'm long 21. So maybe it's like, one guy's short 11 and one guy's short 10, right? On the other side. I can actually go in here and close that specific part of my position where I don't like the counterparty. And then just like reopen it. And at the contract level, the contracts are actually storing like the individual positions, i.e. at the sort of the most granular level. The UI, which is just reading directly from the chain, which by the way, there's no backend here. This is all fully on chain. Is then reading all of these granular positions, aggregating them into like one position because this is what people are used to seeing. And then it allows you to click into, so like details if you'd like to. And obviously you can use alter API as well.
How do you make sure you're not just like getting the same counterparty again when like closing and reopening the position?
I mean, it's possible, but it's unlikely, right? If you have like, hundreds of thousands of people on the exchange, particularly like in the order book, it's unlikely that you would get the same guy. It is possible.
So basically, from what you've been talking about, it seems like what you're building is a lot more akin to like how it works in TradFi with like exchanges and brokers and stuff like that.
I mean, we built an exchange, not a casino.
Yeah.
Is really the bottom line.
What do you think like the effects are going to be? Because I think in TradFi everything is like way more like it's just one market, right? And we have like multiple different ones, if that makes sense. Like our price discovery is on multiple different exchanges. And then what could effects be like, for example, if like yours is basically the only one that has like a circuit breaker, but all the others like keep trading and stuff like that.
So I might not fully understand the question, but tell me if I'm misunderstanding. But what's really interesting is that the one, like there are casinos building on top of us, or on top of the protocol. We don't control it. It's on chain. And the reason is just because like they have like a casino front end, but like as the casino, you want to make more money. So kind of the way we get retail flow is the retail aggregators, and like even retail wants to make more money. So if you just make things easy, I think like it attracts people. But to answer your question, so what's really interesting is that like in the 2,000-year history of financial markets, it's actually never been possible to build world markets what we've built, and the reason is because regulation is designed to prevent conflicts of interest. So the reason we have regulation is because historically, when the exchange was also the custodian and was also the clearinghouse, things blew up, right? So what we saw with FTX like that's happened in history before. And so what regulators do is they say, okay, well, we can't know what every business does every day of the week, right? Because that would require just an army of people on technology. And so what we're going to do is we're going to force businesses to separate their functionality. So, the clearinghouse, the exchange, and the custodian, they all need to be separate businesses. And so if the exchange does something wrong, like in, traditional markets, maybe they have a contract they're trading and they change the fine print, they change the terms, or they change the payout and they don't tell anybody. Or they, there's a market, there's some problem, and they, either cover it up or they don't honor the commitment, whatever it is, because they're trying to protect the exchange. In order for any money to move, right, which is ultimately like what has to happen here, the clearinghouse and the custodian need to agree. And if they see this, they're going to be like, no chance. So and that's how these problems get surfaced and solved. But what happens is you also then dramatically reduce the productivity of those dollars and the kind of efficient relationships because of the separation, right? And so the only way, at least to my knowledge, that this conflict of interest problem has ever been avoidable while integrating markets and integrating market functions is by building the whole thing on chain, because the code can run autonomously. That's like a big breakthrough. So one of the markets we're really interested in is FX, because it's stable, relatively speaking. It is stable. Huge liquidity and way more efficient on a market like world markets than anywhere else in the world, to my knowledge. That's like a really big unlock. Anyway, so you're asking about traditional markets. Like traditional markets, by the way, have circuit breakers. Just to go back to the circuit breaker
that's
thing.
what I was wondering. I think what you said just made a lot of sense. I'm just thinking out loud a bit, because I also don't really know how it properly works. But the NASDAQ is just one market, right? So if there's a circuit breaker in the NASDAQ, you basically can't trade it anymore unless you do OTC stuff or whatever.
Right.
But if your exchange has a circuit breaker, all the other exchanges are still trading Bitcoin or ETH or whatever. The prices are still moving basically. And I was just wondering.
Okay. So in this situation, all right. So one thing I will say is that, and historically, philosophically, I've been against circuit breakers basically my whole career, because I'm just let the market decide. But after October 10th, because I was in the market trading, I thought okay, we actually need circuit breakers, and they exist near ubiquitously in traditional markets. So I think that there's sort of a reason for that. The thing is, in crypto, there are circuit breakers. They just aren't disclosed. So when an exchange doesn't want to honor your orders, they just don't. And running a hedge fund, this happens on a very regular basis. I won't name any names due to NDAs and such, but literally all of the top funds will just not execute your order if they are under stress. And when I say under stress, I mean their internal trading desk is losing money, right? The insurance fund, which has zero transparency, right? And then it's if I have gone to these, gone to exchanges with system logs from their exchange. And I'm talking about top 3 liquid exchanges, not exchange number 99. That say, you didn't, you blocked these transactions. It's in your logs. So pay us back, because if, then whatever, the account got liquidated, or we didn't buy the thing and the market went up, whatever it is, right? And they're like, yeah, you signed a terms of service, and the terms of service says we can do whatever the hell we want because this is a casino, not an exchange, right? Like if you don't like it, get lost. And you can try and sue them, and then there's like arbitration clauses, and it becomes kind of a whole thing. But if the market is behaving badly, they just stop trading, or they just don't tell you about it. That's been my experience. Yeah. And they'll do it for like brief moments, right? Like, if you look at sorry, go ahead.
No, go on. Sorry.
Well, like even like finance, right? If you look at October 10th, well, this is like one of my favorite things. It's like, well, maybe circuit breakers. It's hard to say that circuit breakers would have been like the best solution. Maybe it would have helped, right? Because it's like, hey guys, like known vulnerability being exploited in front of our eyes.
Yeah.
Maybe just like fucking pause the trading for a second, like until this gets fixed. But whatever, it's speculative. It's hard to know. But here's what they did do. Public information. Like if you look, their official statement is that like, oh well, the problem on Binance, like the exploit, happened, on this date at this time. And if you look at the time they say it happened, and you look at like in the chart where there's this like, gigantic, it just falls off a cliff and comes back up. Their official date and time where they say like this was, they don't admit fault, but even if you say like, okay, well, it's not your fault, but like, when did it happen? They say it happened like 20 minutes after it actually happened. They like literally just like fucking draw a different line on the chart. They're like, oh, it happened over here after the market's like fully recovered.
Yeah.
I mean, it's like comical, right? Like, anyway.
I was just going to ask if you could explain a bit the like what is a casino versus an exchange for you, if you can like define that.
Yeah, well, exchanges have like, I mean, you could define it. If you asked a person in traditional markets, they would probably point you to some kind of license and like regulatory requirements, right? In the US, it's an ATS. In Europe, it's an MTF, depending on like, and they have like different rules for different jurisdictions. But I think that there is like, amongst people who use exchanges a lot, and even amongst retail, there is a common sense definition here, which is fair and transparent across counterparties. It's not trading against you. Like, I would say that's the biggest. A casino, you're trading against the house. An exchange, you're not. That's really most rules around exchanges with respect to regulation extend from that principle in some way, shape, or form, right? And then there's just general proper functionality that everybody is used to who is, who trades professionally. Which is, like, there are some nuances around like, counterparties and not pooling risk and like market structure and whatever. But I would say for like the average person, it's just, again, it goes back to like safe and useful. The house isn't trading against you. And you have like a market structure that makes sense. You have features that make sense. I would say that's like the core difference.
Yeah, that makes sense. I think I just have like one more thing before we can wrap it up, which is like what probably many people always care about when a new thing in crypto comes out. Will you have a token? Will there be like a purpose to the token? Will you have like points, incentivization systems, anything like that? Yeah,
we'll have all the good stuff. So there's so the protocol is owned by a foundation. And so the foundation decides all these things. We don't, but we obviously advise the foundation. And our current expectation is that there's going to be a points program. It will favor, I can't say what it will do, but we expect it to favor like early liquidity. And like what you would expect basically. That we expect to launch a token, or we expect the protocol to launch a token. Yeah, I mean, it's like that's the benefit of DeFi. We kind of suck to not do like DeFi stuff. Put in all the effort and not get any of the composability and the sort of democratization and permissionless nature. Yeah. So,
do you have any details about like the role of the token? Will it just be like a governance function or?
Not yet. That's a good question. So, in terms of like one model we quite like at the moment is like fees, right? So if you hold the token, then you either pay air fees or pay discounted fees, like what Binance does with BNB. Yeah, like there may be some mechanism by which in the future the exchange makes money. Like, Uniswap has this like fee switch, right? We may do something similar. The protocol may do something similar.
I see.
So it's like, with respect to the token, the plan is to really lean into, what's done in DeFi, and kind of taking advantage of that.
I see. Yeah, that makes sense. I think that's a good place to stop. We went over various interesting topics. Are there any things that you still feel need to
No,
be
I think
said,
that's
or anything
good.
you want to say?
I do think maybe kind of the last thing is for traders which are, looking to get like a return, right? Like risk adjusted or just sort of, like some of those commentaries are, basis trading, funding rate arb, market making. World markets is, in my opinion, the best place to do it. You just make more money, right? Because if you're doing funding arb, like our funding rates are structurally, or like because of the lending market, they are connected, just through like market forces. So the gap in rates on world markets and on other exchanges, I expect to be more predictable and like enduring. You can lend your collateral, which then picks up like additional returns. All of these like unlocks in the risk engine and sort of the trades that are, that help users take advantage of it. That's all taker flow. Being on MegaETH, I think will have a lot of taker flow. So yeah, I think it's, at least for me, like, I think this is the place to be in terms of any of that kind of trading.
Did you announce the launch date yet? I'm not quite sure if you said something about
Day
that.
one with MegaETH.
Okay.
So we expect MegaETH and therefore us to go live. I don't know what their official date is, so but it's very soon. It's like
I
we're
guess,
talking about
I
weeks.
guess it will be pretty soon. Yeah. Okay. Yeah. Then thank you very much for coming on and having this discussion. And that's it for today, everyone.
Yes, sir.
Goodbye.
Thank you. Have a good one.